Good morning and welcome to the June 23 quarterly update. My name is Steve Bennett and I'm the CEO of the Direct Business here at Charter Hall. We're given this update at a very interesting point in the cycle where we've had 400 basis points of interest rate increases in a little over a year. So the aim for today's session is to run through the update on the funds, give you a few insights into what we're seeing in the market, and cover off some questions at the end that have been sent through during the period. But before we go any further, I'd like to acknowledge the traditional custodians of the land and pay our respects to the elders past, present, and emerging. And like all these presentations that we give, it is very important that people understand we are not able to provide financial advice. The aim of this quarterly update is to provide information, facts, and as well as market research. If you are thinking of investing or you have any questions, we always encourage you to read the offer documents in full and to consult your financial advisor. The way we've structured this morning's quarterly update is that I'll provide an overview of the direct business and the high-level fund performance figures. I'll also mention some of the valuation insights which we've observed across 1,600 properties across the whole Charter Hall Group. And then I'll pass through to the fund manager, Julian Menegazzo, who'll give you some more detail on the underlying funds as well as some specific research insights that touch on the sectors that those funds are invested into. So before we get into the underlying funds and a bit more detail on each of the various property sectors, I thought it'd be useful to highlight some of the overarching themes that cut across each of the funds in which many of you have invested into. So we maintain high occupancy rates. We consistently fill up the properties with strong tenants, so they go through different economic cycles, and wherever possible, we execute long-term leases. The combination of these three factors means that we can provide greater certainty of income, which is paid usually monthly or quarterly, depending on the fund, through to the underlying investors in each of the vehicles. But there is no denying that we are in a more challenging economic environment than which we found ourselves 12 months ago. You can't have 400 basis points of interest rate increases in such a short period of time without it impacting the valuation of assets, and that's regardless of whether you're talking property or other asset classes. We always tell people, and you've heard this many times before on prior quarterly updates, to focus on the medium to long term, and real estate should be a 5-year investment time frame. So whilst you can see up there on the screen, we have had some weakness in valuations and returns over the last 12 months. Pleasingly, across a 5-year period, each of the open funds has outperformed their respective benchmark, which can be seen on the right of the screen. And this is how we benchmark our assets. We make sure we line them up against other institutional grade funds because that is the type of property real estate that we invest into for the long term. So I've just shown you for the open funds the 12-month, 3-year and 5-year returns, but another key factor is the since inception returns. So all the funds up there on the screen show the benchmark, which is in grey, against the blue, which is the underlying fund performance since these funds were created, noting that the Maxim fund is over a 10-year period that we've measured here. Pleasingly, all the funds have outperformed that MSCI benchmark, and the reason why the benchmark does vary is because we take it from the time of each of the launch dates of the underlying vehicles. It's also important to give you an update on the funds which have been closed for investment for a number of years. Importantly, each of those three funds since inception has materially outperformed the benchmark. Their returns vary from 12.3% per annum all the way up to 16.7% per annum. Julian Menegazzo will also give you an update on some of the other key metrics around length of lease term and occupancy rate for these closed-end vehicles later on in today's presentation. I think this is a good point in today's presentation to also just talk about unlisted property more generally and what the return profiles have looked over long periods of time. You can see up there on the screen the returns for unlisted real estate broken down into income, which is the blue bars, movements in the capital values, both positive and negative in the grey bars, and the black dotted line, which is the total returns being a combination of capital movements plus income. What you can see is that yes, capital values do move around. What is very consistent is the level of income that these funds pay out over long periods of time. This next slide shows where the unit prices finished at 30 June 2023 for each of the direct suite of funds. Remember, during the quarter, all our funds had independent valuations undertaken. We've also tried to highlight here the classification showing which funds are open for investment. And remember, an investment into a direct property fund should be considered a long-term investment, noting the illiquid nature of the underlying investment class. So across the wider Charter Hall platform, we had approximately 1,600 assets independently valued in the June quarter. What I thought would be useful to pull out just a couple of the key trends in each of the core sectors of office, industrial and retail, and draw them out for you. In the office market, it was very clear that the valuation impacts were more noticeable on secondary or lower class assets. The tenant markets are clearly favouring prime or higher quality assets, where tenant demand is clearly moving into those assets at the expense of the secondary. There has also been a more cautious approach by investors to the office sector, particularly as the work from home trends continue to play out. In the industrial and logistics sector, we've seen extremely tight vacancy rates, and Julian will give you some statistics around that, but overall we've seen vacancy rates of around 0.6% across Australia. That's led to very strong rental growth, so whilst capitalisation rates have also increased in the industrial and logistics sector, for many cases, or the majority of cases, the rental growth has been able to offset some of that movement in cap rates. In the long WALE or convenience retail, you have seen lower investment demand as interest rate pressure has also impacted this sector. Performance, however, of some sectors within the retail component has been more diverse. Social infrastructure, particularly with assets that have CPI-linked rental reviews, has continued to perform strongly in what is more a challenging environment overall. This next slide, which I'll shortly put up on the screen, I think is quite interesting. It shows the transaction volumes over a long period of time broken down into the core sectors of industrial, office, retail, as well as a very small proportion of mixed portfolio sales. What's been clear is that the increase in interest rates have definitely impacted and lowered the level of transaction volumes in the market. And apart from a brief period impacted by COVID when it first came in, you can see that transaction volumes in the 12 months to June 23 are actually at the lowest level we've seen in over 10 years. So whilst at Charter Hall will continue to curate portfolios, continually focusing on increasing the quality, what you have seen is that the lower transaction volumes mean that you need to be more targeted around what you dispose of as well as what assets you acquire. And at Charter Hall, we are constantly curating the portfolios. So whether we're in a little bit more challenging economic environment, which we are now, or when interest rates were extremely low, at Charter Hall we continue to sell assets and upgrade the quality. Some specific examples up here on the screen are around PFA's recently announced sale of the New South Wales campus out at Kensington for $80 million. LWF also recently disposed of an asset up in Coffs Harbour as part of the regular strategy around providing liquidity at the 5-year liquidity events. And DIF4, which is around a $3.5 billion industrial and logistics fund, which is selling assets where we believe value's been maximised, and also some of the very small value assets which don't actually impact or move the returns of the fund. So before I introduce Julian Menegazzo to come up and give an update in more detail on the underlying funds, what I thought would be also useful is to show you a video of one of the recent assets that DIF4 has purchased. So not only is DIF4 selling assets where we think value's been maximised, but it's continually upgrading the quality. And this video will highlight an asset located in Adelaide, leased to Cleanaway, which is a brand new constructed facility. So I'd now like to introduce Julian Menegazzo. He's the fund manager and responsible for the $10.5 billion of commercial real estate that comprise the direct funds. He's responsible for growing the institutional quality of the investments, as well as the execution of strategy, portfolio construction, capital management, asset management, as well as corporate transactions. Please welcome Julian Menegazzo.
Thank you, Stephen. Before diving into the funds, I would like to take this opportunity to provide you an update on how the industrial and logistics sector is positioned. The strong market fundamentals continue to play out across the sector. You can see on this slide how well Australia is positioned, having a vacancy rate at 0.6% nationally. This is the lowest vacancy rate in the world and is expected to continue to remain at this level as future stock is completed across the sector. This slide illustrates how the vacancy rate across the sector has compressed since December 2019, when it had a vacancy rate of 6.3%. Low vacancy, continued leasing demand, and the limited land supply is driving strong market rental growth across the sector. Over the 12 months to June, the national rental growth now sits at 22%. This rental growth story is expected to continue, being largely driven by the strong fundamentals that continue across the sector, including low vacancy, shortage of development land, and forward development supply pipeline being largely pre-committed on completion. I will now move into the Direct Industrial Fund number 4, or better known as DIF4. DIF4 now has a portfolio of $3.5 billion in size across 62 directly held assets. It provides 100% occupancy and a 10.2-year weighted average lease expiry profile. You can see up on screen both the quality and diversification of the tenant customers comprising the top 10 tenants within the fund. The fund has been actively curating the portfolio, divesting over $105 million in non-core assets over the 6 months to June. Despite the capitalisation rate softening in the recent independent valuations, the market rental growth has almost fully offset this softening. The fund has delivered a 10.7% investment return since inception, having benefited from the strong industrial market fundamentals that continue to play out across the sector. DIF4 pays distributions on a quarterly basis. The next fund is the Charter Hall Direct Long WALE Fund, or better known as LWF. This is our diversified fund that is also open for investment. LWF provides investors access to a diversified portfolio across a number of sectors, including industrial and logistics, social infrastructure, office, and long WALE retail. The fund's top 5 tenants comprise over 65% of the fund's income and benefits from federal, state, government, Coles and Bunnings, who dominate the home hardware market. This fund also benefits from an 8.7-year weighted average lease expiry profile and 99% occupancy rate. LWF pays distributions on a monthly basis. The fund recently offered all investors the opportunity to participate in the fund's 5-year major liquidity event. Management has recently written to those investors that elected to redeem their units, providing details on the fund's liquidity strategy. If you have not received this communication, please contact one of the Charter Hall team who would be happy to assist in getting you this communication. Moving now across to the office sector. Despite the headlines, tenant demand remains positive in the Australian market. This slide up on screen compares the US office net tenant demand versus Australia's net tenant demand, and you can see how Australia differentiates versus the US office market since the COVID recovery. Whilst we are not saying Australia has not been impacted, the return to office has differed by market, and the re-entry to office has been far quicker and more advanced across the Asia-Pacific markets, like Australia, than any other market globally. Tenants are now demanding prime quality office buildings when compared to secondary, lesser quality office space, and this highlights the importance for landlords to continue to invest in office assets, differentiating their product versus competitors. Whilst the work from home thematic will continue, there has been a shift by some of the larger organisations. Over recent months, there has been a collective motivation amongst firms, governments across the globe to get employees back into the physical office. We have recently seen the direction from a number of large CEOs mandating a return to the office between 3 and 5 days a week. You can see up here senior management in large organisations such as CBA, NAB, JP Morgan and Amazon, just to name a few, have started to mandate a return to office for their employees. Whilst this is not unexpected, there will be likely more organisations that we believe will start to follow this trend. Whilst we can't control the slowdown in transaction volumes and market movements in capitalisation rates, we can control leasing outcomes, which involves keeping our buildings full and ensuring they are generating as much income as possible and keeping also our gearing in line with the target ranges outlined in the PDS documents. The asset management team at Charter Hall continue to focus on maintaining this high occupancy and driving positive leasing outcomes across both DOF and PFA. Across these funds, we completed over 64,000 square metres of leasing, over 60 deals in financial year 2023, with the average lease term a little over 5 years, lining up with the weighted average lease expiry profile of these funds. You can see on the right-hand side how the occupancy rates across DOF and PFA compare at 98% versus the PCA average at 86%, which is a great result in the current environment. At Charter Hall, we are property professionals located in all major office markets, and this provides us a deeper understanding of what our tenant customers are seeking and assists us in keeping our buildings fully occupied in the current environment. Moving now to our first office fund, the Direct Office Fund, or better known as DOF, which is open for investment. DOF has a portfolio value of over $3 billion, and its investment strategy focuses on core CBD and established Australian office markets, with 94% of the portfolio weighted to the eastern seaboard and over 70% weighted to the highly sought after Sydney and Melbourne office markets. The top 5 tenants comprise close to 60% of the fund's income, benefiting from state, federal government, as well as other high quality tenant customers including the Western Sydney University, Coles and Westpac. The fund benefits from a very high occupancy rate of 99% and a weighted average lease expiry profile of 6.2 years. The fund has also generated investors with a 12.3% total return since the fund's inception and benefits from a high environmental rating. DOF pays distributions on a quarterly basis. The other sector-specific office fund is the Direct PFA Fund, or better known as PFA, also open for investment. As Stephen mentioned earlier, despite the challenges around the office sector and the unit price coming off as at 30 June, the fundamentals that we can control within the fund are positive, with the fund sitting at an occupancy rate of 98% and a weighted average lease expiry profile of 5.9 years. The PFA fund has a focus on properties leased to state and federal government, and the government rental streams account for over 60% of the fund's net income. Following the recent reported sale of the University of New South Wales in Kensington, the proceeds from the sale are expected to be received from the purchaser in early September. Following the receipt of the sale proceeds, management expects to make a further partial redemption payment expected to occur in September 2023. Moving now to the Wholesale Property Series number 2, or better known as WPS2. This fund is open for investment to wholesale investors and sophisticated investors as defined by the Corporations Act. This fund provides a long weighted average lease expiry profile of 11.8 years and a high level of occupancy at 99%, providing investors exposure to a diversified property sector allocation. This fund is a little bit different as it provides investors a diversified sector and allocation across industrial and logistics, social infrastructure, office and long WALE retail, as well as a small allocation to the listed A-REITs, providing access to some of the highest quality assets across the Charter Hall wholesale funds and partnerships. This fund is also open for investment and has a minimum investment allocation of $250,000. If you're interested in this product, we fully encourage you to read the information memorandum or consult your financial planner to understand the risks and structure. As I mentioned earlier, this is a little bit different to our other funds. Finishing up the fund update, I will now cover the fixed life funds. These funds are closed for new investment, being the BW Trust, DIF3 and WPS1. BW's liquidity event occurs in Q1 2024 and provides investors access to over $138 million of a Bunnings portfolio, providing a WALE of 5.4 years and is 100% occupied. DIF3's liquidity event is not until Q3 2024, and the fund delivered a 12-month return of 4.5% and provides access to our industrial and logistics portfolio with a 10.5-year WALE and is also 100% occupied. WPS1 provides investors a weighted average lease term of 9.1 years and exposure to an underlying portfolio of over 270 properties. The fund is in its 3-year investment period. This now brings me to the end of the fund updates for the June quarter. I will now hand back over to Stephen, who will cover off a number of questions that have been submitted over the quarter. Thank you very much.
For each of the funds in the Charter Hall suite of products, we have particular gearing targets which are documented in the PDS or the information memorandum. Typically, they're between 30 and 45% gearing, and I can confirm at 30 June, every single fund was within their target gearing bands. In fact, the level of gearing is documented for each fund in the June quarterly report, which you should have received. The other area to focus on is what does higher levels of interest rates do to the fund earnings? Typically, we hedge through interest rate swaps between 50 and 70% of the interest rate exposure. We've got a dedicated and experienced treasury team who helps the fund team manage this. But obviously, in a higher interest rate environment, the piece that isn't hedged does ultimately reduce the fund earnings slightly. And so despite DOF and PFA having very strong occupancy rate of 99, 98%, strong tenant covenants, government, Westpac and so on, there are things that we cannot control. So in an interest rate environment that's rapidly increased, it's led to higher capitalisation rates, and as I mentioned earlier, lower transaction volumes. So whilst we do have teams that have done some excellent leasing and we've maintained high occupancy levels and strong levels of cash flow, these other aspects do flow through to the way office valuations, and that is the predominant reason why valuations across DOF and PFA did come off at the 30 June quarter. And that now concludes our June 23 quarterly update. Hopefully we've been able to give you some insights into the market, and if there is anything that we haven't covered which you'd like to learn more about, I encourage you to reach out to the team or the registry or even check our website. Thank you very much for taking the time to listen to this update.